Welcome, directors, board members, and fellow analysts. My name is Allie Dyer, Senior Financial Analysis Expert at ATD Investments. Today I'm going to walk you through an investment opportunities plan. We were tasked with finding 3 industries that offered value add to our portfolio. The first industry we took a look at was the healthcare. The first company was Quest Diagnostics. They provide diagnostic testing, information, and services. They operate a national network of full-service laboratories, rapid response laboratories, and patient service centers. Over the last 5 years, they have had very good liquidity. Their short-term solvency, both the quick and current ratios are over 1 and increasing. The cash ratio is pretty low, but that seems to be industry-wide. They do have a lot of debt, but it seems like they're handling it really well, as you can tell from the total debt to equity ratio. That's pretty consistent. Their asset management, you can look at the total asset turnover, is very, very consistent, within 0.01 over 5 years. Their return on common equity, return on assets, and assets to equity is all really great. They're increasing where they should be. There's a little bit of hesitation right about here in 2013 where they seem to have hit a snag, but they came back pretty well. And it does look like they're suffering a little bit right now, but I'm sure they're going to get a handle on it. We also have their market to book value ratio, which is increasing. Same concept. They had a couple of bad years here and there, but I think on average they're doing really well. The second company was Laboratory Corporations of America, which is a clinical laboratory company that offers clinical laboratory tests used by medical professionals in routine testing, patient diagnostics, and in monitoring the treatment of diseases. Over the last 5 years, they have had some rough patches as well. Current and quick ratios look really good. Quick's a little low now, but I'm sure they're going to come back from that. Cash ratio, a little odd. They had very high here compared to the rest of the industry, and then it's going back to about the industry average right here. Short-term, long-term debt, really high, and it doesn't look like they have quite a handle on it as Quest had with paying it back, but it's not out of control. Their asset turnover is very consistent. It does look like they're having some trouble this year though. Their profitability is very decent, but at the end, the last couple of years, it has been decreasing. And the market to book ratio, the last 2 years has been declining. The last 3 years has been declining, which isn't great. Next company is Index Laboratories, which provides diagnostic, detection, and information systems for veterinary, food, and water testing applications. The company also operates an international network of veterinary reference laboratories. For them over the last 5 years, it's been a little different. They are not doing quite as well. All 3 of their liquidity ratios are under 1, which isn't usually good. They don't have a lot of debt, but it is increasing, and they're not doing very well to pay it off. And then it's not listed for the last 2 years, but if this is any indication, I don't think they're doing very well. They are profitable, it looks like. They have a pretty decent return on common equity. This is a pretty big jump right here. I'm not sure what happened, but then there was 2 years where it's not recorded, so I don't feel comfortable making any kind of conclusion from that. And then there's a market capitalization to book value, which was pretty great. It was increasing, and then all of a sudden, something very crazy has happened in 2015 and 2016 to this company. Next company was NeoGenomics, Inc., which operates a network of clinical laboratories that specializes in cancer genetic diagnostic testing services. The company's service includes cytogenics, fluorescein in situ hybridization, also known as FISH, flow cytometry, morphology, anatomic pathology, and molecule testing. Over the last 5 years, they have been doing pretty well. If you look at their current quick ratios, their current is over 2. Their short-term, long-term debt, they do not have very much debt, but it also doesn't look like they're able, this total debt to equity is a little odd. Doesn't look like they're paying it off very well. Then we have our profit margins, asset turnover, operating margins. All that tells us if they have good systems, management, all that kind of stuff in place. As you can tell, it is decreasing, so they probably don't have that great of management system going on right now. They have their asset to equity, their price earnings ratio, and their market to book value. Their PE ratio is crazy right here in 2013, where it dropped to 90.5, and then it's up to 16,000 in 15. Last but not least, for the healthcare industry, there was Hooper Holmes Inc., which provides medical and other underwriting information on insurance policy applicants to the life and health insurance industry. This company does not look too great on paper. Their current quick and cash ratios are all seriously low, so they're not handling their debt very well in the short term. And then in their long term, it doesn't look like they have very much debt. But this number right here scares me a lot. I don't know what happened in 2015 to cause them to have so much debt, but it did. Their profit margins are minuscule compared to the rest of the industry. Operating margins, return on common equity, and return on assets are all in the negatives across the board. And then their market capitalization to book value, it did something here in 2015. This was a crazy year. It was probably because they took out all that money. And then it went back to a negative number here in 2016. The next industry that we analyzed was the non-alcoholic beverage industry. The first company that we looked at was Dr. Pepper Snapple, which is an integrated brand owner, manufacturer, and distributor of non-alcoholic beverages in the US, Canada, and Mexico. The company offers flavored carbonated and non-carbonated, ready-to-drink teas, juices, and mixers. Over the last 5 years, they've been doing pretty well. Their current ratio is over 2.5, which is great. Their quick ratio is 2.27, and it's been increasing every year. Their cash ratio, same deal, 1.7, which is great. It went down a little bit here in 2013, but I'm sure we can see why. Their long-term solvency is doing pretty well. They're increasing their short and long-term debt, which is typical. And they're handling it looked like decently until right about 2015, and then it got a little bit out of control. They are profitable, as you can tell, but their profit margins are tiny. Oh, never mind. They're pretty decent, and they're increasing. Asset turnover is always a really great indication of good management, and so is operating margin. So as you travel across, you can see we've got pretty decent right there, and they're increasing, which is always a good sign. Also, your PE ratio and your market capitalization to book value increasing, very good sign. Refresco Group. It operates as an independent bottler of soft drinks and fruit juices for retailers and branded consumers. The company produces beverages including fruit and vegetable juices, carbonated soft drinks, nectars, lemonades, mineral waters, iced tea, energy, and sports drinks. Over the last 5 years, they've been doing okay. As you look at their cash ratio, it's at 0.23, which is not very good, especially compared to other companies within the industry. They have short-term, long-term debt. It looks like they're getting much better at handling their debt as we go across the board, because it's been very consistent, but they're getting better. My profit margins did not look good in 2013 and 2012, but as we go, they're learning and they're getting better. Their asset turnover operating margins are doing okay. Their profit margins could absolutely be higher. And they've got return on common equity, return on assets, not doing too well, but they did catch it in about 2014. Something happened there, and they got everything under control. Possibly new management, maybe new systems, something like that has really helped them get their balance back. And then their market capitalization to book value, we don't have the first 3 years listed, and then it does decrease, but that's not enough information to really draw any kind of conclusions. National Beverage Corp is a holding company for subsidiaries that market, manufacture, and distribute a full line of beverage products. The company includes multi-flavored and cola soft drinks, juice and juice products, flavored carbonated and spring water products, and specialty items. Over the last 5 years, they have had a great run. Their cash ratio is 1.4. Everything is increasing across the board consistently. Their long-term debt, they actually have a structure that is almost 100% equity. They don't have any debt anymore, but when they need it, it looks like they do take it out, which our company does like. We have a profit margin that is increasing. They had right here in 2014, there was something that happened, but they rebounded in 2015, and then they're increasing for 2016. ROE and ROA are doing fantastic. It is decreasing right here a little bit, but even at 35, that is an awesome return on common equity. And then with your return on assets being at 22.12, that's awesome as well. Price earnings ratio, it decreased right here in 2013, but it's not too much of a concern because right here, you've got it up to 35.66, which is fantastic. That's up 100%, over 100% from the 2013 instance. Monster Beverage Corporation is a holding company. The company, through its subsidiaries, markets and distributes energy drinks. They are doing fantastic over the last 5 years. With a current ratio of 3.04, they've got a cash ratio of 1.27, but some really odd stuff is going on right here in 2015. As you can tell, their numbers are skyrocketing. And it can't be because of debt, because as you see, they don't have any debt. Their profit margins are very great. They're decreasing a little bit here and there, but the last one's the one we're looking at with 23.37% profit margins. Asset turnover operating margins doing pretty well, from 26 to 35, and then from 41 to 17, that's not good. Return on common equity, right here is our issue. And then our price to earnings ratio and market capitalization to book value, we've got very great steady increases. This is awesome. And then something happens and they drop down to 34.22. We don't like that. We have our market capitalization to book value, which is consistently increasing again until 2016, where something must have happened within the company. Last but not least, Coca-Cola Bottling Company Consolidated, which operates as a holding company. The company, through its subsidiaries, produces, markets, and distributes non-alcoholic beverages such as energy drinks, bottled water, ready-to-drink coffee, enhanced water, juices, and sports drinks. Over the last 5 years, they've struggled, it seems. Their cash ratio is 0.05. Compared to the rest of the industry, that's nothing. They have a huge market, and they have a gigantic piece of that market, but for some reason, their ratios are not great. And it may be because of their debt. They are increasing in debt consistently, which does make sense, but it doesn't seem like they have a fantastic handle on that debt as you go across. 263.34, I mean, that's not handling your debt well. We've got our profit margins, asset turnover, and operating margins, which their profit margins aren't terrible compared to the industry, but they could be so much better. National Beverage and Monster had much better profit margins. Asset turnover is decreasing, which is good. And then we've got our operating margins, again, an awesome indicator of good management and great systems. Not doing too well with it decreasing over the last 5 years. ROE and ROA. ROE, it's okay, but it's decreasing and it's definitely not consistent like we like. And then your ROA, that is not high enough for us. The last industry that we looked at was the industrial services industry, and the first company is Manpower Group Incorporated, which provides non-governmental employment services through offices located around the world. The company's principal operations include temporary staffing services, contract services, and training and testing of temporary and permanent workers. Over the last 5 years, they have had a pretty good year. A pretty good 5 years. They're doing really well right now. So they have a current and cash ratio that's consistently increasing. Their cash ratio for this industry, again, when you're dealing with service industries, your cash ratio is just not going to be very high. There's not a lot of inventory and all of those kinds of factors. So it's pretty low, very common in this industry, as you'll see. short and long-term debt. It's increasing, not crazy increasing, and they definitely have a great handle on that. Their profit margin, asset turnover, and operating margins. Profit margins are not very high, but again, that's just something that we're dealing with in this industry. Asset turnover is decreasing, it's what we like to see. Operating margins are increasing, also what we like to see. Their return on common equity, return on assets are both doing pretty decent. They are increasing across the board, which is what we like to see. And then lastly, you've got your market capitalization to book value and PE ratios. Market to book is doing pretty well. I think there's definitely some more room for improvement there, but your PE ratio is doing really well. They could also use some help there as well, though, I believe. Second company is Insperity Inc. provides human resources and business optimization services. The company offers recruiting, employment screening, retirement, business insurance, and technology services. NSP also provides performance and expense management, time and attendance, and organizational planning software. Over the last 5 years, they're not doing quite so hot. Their current ratio is declining. Their quick ratio is following that same pattern, which also means their cash ratio is declining. It is higher than the last one, but with it decreasing, that's not great. They, for 4 years, had no debt, and then last year, it looks like they took out some loans, and they have some promises to pay back now. But they didn't have the systems in place, so it doesn't look like they have a great handle on it, but we'll see how they do. Their profit margin, asset turnover, and operating margins. Profit margin it was decreasing, and then it held back a little bit, and they're working on that. It looks like they're getting their profit margins up, which is the first step to, bringing your company back. Asset turnover, which is very important. We have increasing. That's not that great. We want it to be coming down. Operating margins, we also like to see that coming up, which is not very consistent here. You see it's decreasing, decreasing, increasing, increasing. ROE and ROA. For ROE, it's decreasing, decreasing, increasing, and then jumps up. That is probably due to the fact that they took out that money, because debt magnifies losses and it also magnifies gains. So sometimes that's what's motivating their earnings, is debt. TriNet Group Inc. provides human resources and consultation services. The company offers payroll, tax administration, risk protection, performance management, compensation consulting, and employee benefit plans. Over the last 5 years, again, not exactly what we like to see, but in these industries where you have low inventory, lots of people, lots of labor costs, you're not going to see a really high cash ratio. So with this being so low, it's not a terrible thing in this industry. So the next step is moving on to see how they're doing with their debt. Are they able to pay it? And this company does not look like they're able to pay it at all. Their profit margins they took a dip right here and then they jumped back up in 2016. Could possibly help them out. We have asset turnover, operating margins, decreasing, little increase, decrease, 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 little increase. So across the board, they're not doing very well, but it does look like they're trying to come back here in 2016. The ROE, ROA, we've got nothing listed for ROE for the first 4 years, and then a fantastic ROE here. Again, probably leveraged a lot by the debt. Your ROA, pretty low. Market to book capitalization and PE ratios, we've got 2 years unlisted, and then negative ROA, negative market capitalization book, excuse me. And then it comes back, and then it decreases by a giant percentage right there. AMN Healthcare Services is a temporary healthcare staffing company that provides travel nurse staffing services. The company places nurses and allied health professionals on temporary assignments at hospitals and healthcare facilities. Over the last 5 years, they've been doing pretty well. Their current ratio is 1.64, their quick ratio is 1.46. As you can tell though, it's decreasing, and then they increase here again. So across the board, we're having some trouble in this industry 2013 and 2015. Their quick ratio is doing pretty well. Their current cash ratio is really low, but that's what we've been seeing across the board for this whole industry. Their debt looks like they've got a really good handle on their debt, keeping it pretty consistent across the board here. Profit margin, asset turnover, and operating margins. They've got increasing, decreasing, increasing. So profit margin, that's good. Asset turnover, pretty good, very consistent. Operating margins, pretty good. Return on common equity and return on assets. Return on common equity is doing really well. It took a little dip right here, but that's not a huge issue because it's not a giant dip. And then return on assets, the same concept, they're doing pretty well there. And then we have our market book capitalization and PE ratios here. PE ratio is declining, increasing, declining, increasing. Don't like the inconsistency there. Market capitalization to book value, we're increasing, and a little decrease there. True Blue Inc. provides temporary manual labor to the light industrial and small business markets. The company operates dispatch offices in the US, Puerto Rico, Canada, and the UK. True Blue's customers are primarily in the transportation, warehousing, hospitality, landscaping, construction, light manufacturing, retail, wholesale, and sanitation industries. Over the last 5 years, they have been doing pretty well as well. As you can tell, their cash ratio is very consistent with the industry. Their current ratio is increasing, decreasing. I don't like the inconsistency, but it's a very high ratio across the board, almost to into the threes right here. Our quick ratio, same concept. You're increasing, decreasing. So it looks like they have a good year, they have a bad year, they have a good year, they have a bad year. Their short-term debt, it looks like it's increasing across the board. They paid off a little bit here, and then they still have a little bit left to pay off, but they are doing a great job at covering that debt. Their profit margins were pretty decent, and then for some reason here in 2016 they took a loss on their profit margins. It's unfortunate. Asset turnover for them is going pretty well, so they've got an increase, a decrease, and a decrease. Operating margins, decrease, increase, decrease, and then again with that negative right there. Return on common equity, return on assets, 4 years are doing okay, a little bit of fluctuation, and then it hits us again with that negative. It's just really unfortunate. Something's going on with their company here in 2016. Their market capitalization and book value also shows that as you go across the board, and then it drops back down to under 2. So now that I've gone over all 3 industries, all 15 companies, we're going to take you in to see which ones we chose as our top companies. First is National Beverage, also Fizz. Their enterprise value is plus 92.51. Their last price was 98.88 with a 5-week high of 129.82 and a 5-week low of 45.13. This shows us that at this price, if we purchase this, we have a lot of room to grow, and they've come a long way already, and I see them going a lot further. So as you can tell, with their current quick and cash ratios increasing, we then have their total debt to equity going down. It does look like in 2013 they took out a very large loan or something of the sort, but they're doing a really good job at paying it off. Their total asset turnover is exactly what we like to see. It's declining, very consistent. Profit margin, ROA, and ROE. Your ROE is declining a little bit over here, but that ROA is coming up to meet it, which is a good sign. Their profit margin is very consistent across the board. And then what we wanted to do, we wanted to break down that ROE for you so you could see exactly where all those numbers are coming from and what's driving the ROE. So we've got our tax burden and our interest burden very high up here. Our operating asset and leverage down here. There's also your equity multiplier. Your market value, so PE ratio, pretty good, pretty consistent across the board. We had that same little spike right here where they probably took out some large loan. EVA, their economic value added, is very decent, very consistent, and the market to book even more consistent, which we love. Second was out of the healthcare industry, which was Quest Diagnostics. Their economic value add was plus 188.27. Their last price was 93.2. Their 52-week high was 111.97, and their 52-week low was 80.52. Same concept, lots of room to grow and make money on our investment, and they've come a pretty far way. Their current quick and cash ratios, all increasing. Right here in 2014, they did take a slight hit. It does seem like that, but they bounce back really well, which is what we look for when we look at companies. Their total debt is pretty high, but it looks like they're doing a fantastic job at paying it back. That might be because of the fact that their total asset turnover is going down so much. They're doing a great job at getting that down. Their profit margins, ROA and ROE, are doing the same thing, very consistent across the board. 2013 was our little problem year, but there's no other big spikes, which we like to see. And here's that breakdown again for you, same concept. You've got your tax burden and your interest burden really magnifying this whole thing. And then your operating margin doing really well down here, very consistent. Asset turnover and EM straight across the board. Their PE ratio, market to book, and enterprise value. Market to book, consistent across the board. Price to earnings ratio is going up. Enterprise value is going up. Those are all exactly what we like to see. And then in our industrial services industry, the top company was Manpower Group. Their last price was 93.02. Their 52-week high was 112.97. 52-week low was 80.52. Again, we really like that margin right there so that we know that we can make some money right there. And then they've come a pretty far way in the last 52 weeks. This one is completely driven by, oh wait, no, this is the current quick and cash ratio, my bad. So there is their current and quick ratio, very high across the board. It's declined just a little bit, but it's still higher than what they started off with, so that's good. I wish they would have kept going up a little bit, but hopefully they'll jump back. Their cash ratio, again, declined a little bit. It does seem like 2016 has been a hard year for this whole industry. Here we go. This is your total debt and debt to equity ratio. So it looks like right here they had paid off a whole bunch and then they had to take out some more money, but you know, they're going to pay it off, and it looks like they do a pretty good job at containing that. Their total asset turnover, that same beautiful downward slope we like to see. And then our profit margins, ROA and ROE, increasing, increasing, and increasing. The breakdown here, run by the tax burden, interest burden, operating margins, very nice, consistent, asset turnover and leverage, straight across the board. PE ratio, market to book, and enterprise value, increasing, increasing, increasing. A little dip right there, but it's really not bad. It is increasing. That is higher than it was back in 2012. And then lastly, I'd like to take you through some similarities and some differences across all three industries. Some similarities were that most of these companies had very few suppliers. Some only one supplier, maybe to as much as 3, 4 suppliers, which I guess being large companies, it's hard to find suppliers that you trust. But at the same time, that puts a lot of stress on the company. If one supplier can't supply, they could be out for the month, or they have to come up with a creative solution on the fly. They all have interest rates of under 3%. So most of these companies were driven specifically by equity. Almost 80% or higher of equity was what the company structures looked like. So that 20%, give or take, 5-10%, was all at an interest rate of under 3%, which I found to be really cool. And then some differences was that the service industries had a much lower capital expenditure cost. They were spending less money on inventory and things like that. But the manufacturing companies had a lot more growth potential. I think that's because of the consistency of assets, that once you accumulate them and you get those processes down, those operating margins, those asset turnover ratios, you get all of that to where you want it to be, and then that's consistent across the board. There's not training involved, there's not human capital involved, there is, but not as much. And so lastly, and certainly not least, I just wanted to tell you our top company. So the top company that we chose was National Beverage. And the reason was not only because of all of their great ratios and everything, but it was really because of that problem that we saw within the industry in 2015. So what was happening was the market's needs are changing. A lot of people no longer want those super carbonated soft drinks with all the sugar and bad stuff. Moms don't want to give it to their kids. Adults don't want to drink it. People with health problems can't drink it. So National Beverage did something very cool. They released their LaCroix brand of non-carbonated, no sugar added, very efficient sodas, and it has increased them amazingly. And to us, that is a disruptor in an industry that's been around for a long time. And we like to see things like that because the industry is so profitable already. People are always going to want soft drinks. It's great to see someone who can think outside the box. And so with all that being said, there are 3 companies that we would choose, but out of all of them, we would love to invest in National Beverage Company. Thank you for your time, and if you have any questions, please let me know.